This is Jonathan Camarda with a brief late October update. Okay, so a lot going on, so we're going to get right to it. Economically, things starting to deteriorate even further, as we look across the spectrum. And you saw that came out with the Fed. The Fed said we're not going to hike probably here in November because the long end of the bond yield curve is doing our work for us. And what he meant by that is long-term rates obviously are accelerating to the upside. Now, there's a few reasons I'm going to get to for that. So that should have been good news, but the market continued to break down last week. So although we've been somewhat neutral and we have some caveats of positivity, but we're just going to color it the way it is right now, is that we are watching this very closely. So there's a few things to it. Has made up a word. It is a word. I don't know. Bond declination. Okay, so anyone in bonds this year, if you're in a 60-40, that 40% of your strategy is probably about down 5% year to date. So folks that you know that perhaps have the misfortune of that allocation, or muni bond holders, generally flipping those coupons on most muni bonds across the board. What's going on? The Fed is getting rid of their bond inventory, and the globe is not buying. Say sovereign wealth funds globally are not buying our treasuries. So when you have an increase in supply versus demand, guess what happens to rates? Goes higher. So let's look at the 2-year, 10-year. Right, 2 years almost at 5.25%. 10-year we talked about, could get over 5, and it's right there at 4.99. And so this has created some consternation, certainly in equity markets as well, not just the malaise of the fixed income market. Now, we have in our conservative strategies and as such where we've been hedging and being short the long end of the yield curve and long interest rates to hedge out, and that's held up pretty well over the last couple of months of volatility. On the equity side, again, we still remain neutral, however, are starting to get a little bit more bearish there. Now, this is seasonally a strong time of year. And as you know, I look at Forex, I'm looking at options, institutional trading. And so when we look at the options market, the put-to-call ratio, that is institutional selling versus buying, is now approaching levels at 0.75 where they were last fall. Now, the market bottomed then, but of course we didn't have the geopolitical macro disaster that we have right now. U.S. debt is now at World War II levels of GDP. Mortgages, 8%. The mortgage, 8% rates are here, friends, and it's going to stay for a while. As we look at the mortgage market, home prices are going up. It's up. $394,000 average price, $3,000 a month is the average mortgage payment, and we're not talking about on upper six-figure homes. We're talking about on $300,000 houses here. The mortgage rates are going up. So again, when you look at debt, again going up, and it continues to rise here over the last couple of months, big time. So on the equity side, higher rates. Well, what has hit some real lows that we're watching? The Russell 2000 small cap index. Not a lot of exposure there for you folks as we've seen this bleeding really over the last several months. No shock. Smaller companies that have to borrow at higher rates, the cost of capital, that is not good for profits. Also, financials are a big component of that small cap index as well, and they've had their own issues really since March, especially on the regional bank side, right? Not a lot of exposure there, but need to mention it. When we look at domestic equity markets where we're mostly deployed right now, of course, has made sense really over the last several years. The S&P 500 is now on a 6-month chart below its 50 and 200-day moving average. The Dow Jones easily below that, as it's been the worst performer year to date after holding up well last year. All you have to do is look at some of your consumer staples at home. Your favorite names, look at those stocks this year. Awful. Down well in the double digits, most of them. The NASDAQ now is kind of holding up the best, right? Technologies that performed best this year, at least to this date. All right, we have some big earnings next week. Getting to that heart, the meat of the order, right? If you're a baseball fan, got to see what they do there. So again, we want to watch earnings from that standpoint. NASDAQ holding between its 50 and 200-day moving averages from that standpoint. You can go online, look at charts. Always say, try to educate yourself. So again, you have a good understanding, of your money. So 50 and 200-day moving averages, NASDAQ's in between, S&P 500 and Dow Jones below. Now, is it all doom and gloom? Well, not all, because these are sometimes the market in these environments are trying to find a bottom. We shall see if that's the case now. Now, again, what does it mean for your portfolios? Again, we are taking a few pitches, metaphorically speaking, into earnings. 17% of our earnings have come out, 73% have beat. But again, it has been a challenge, especially when you look at the US dollar. Next thing I was going to get to is taking a little bit of a breather versus the euro, the yen, as well as the Canadian dollar, but still in uptrends versus all of them. So definitely watching that as well. Now, something that also for the first time is really showing some surge capability is gold. So we are watching that as well, and may begin to participate there as well. So some folks that maybe we don't make moves on just getting in for a fast trade on gold. It's a longer term economic situation. And once we break through certain levels, it's a long-term ride on that horse. So again, you really haven't missed the party there if things continue to deteriorate. Now, gold going up and the dollar going up, generally not the case. That has caused some consternation on our part as well to participate, because generally they're inversely correlated. And with a strong dollar, usually gold prices are down because gold is what? Denominated in dollars. However, with the geopolitical background and the macro overhang of everything going on globally, you can watch your news stations for, that may cause gold going up as well. So again, a lot there. Fixed income, we have very little exposure there except on the short end of the curve. So let me finish with that. You're short, like your very short-term treasury bills. Again, we're getting plus fives in a percent rate return as well, in yield rather, and on your money markets, of course. Again, the money markets that you've seen in the Schwab accounts as well have been very attractive, brake pedals, and really a substitute, right? Like substituting your favorite toothpaste when the price goes up for some folks out there, probably not most of you, but that substitute for fixed income, right? No reason to be anywhere over a few years in duration on that yield curve, like surfing at dusk in Southern California. Not this guy, although I'm not really a great surfer anyway, so I'm probably the wrong guy to state that, but I'm going to say it anyway. On that note, we will stay eternally vigilant. You guys out there, try to stay frosty. Again, we will be making changes to strategies as the macro conditions call for it. If you have any questions in between for a little bit of inside baseball play-by-play with your personal wealth advisor and your unique, and we do say unique, risk appetite as you earn the money, we just have the privilege of managing it for you. Definitely don't be shy. Let us know. Until next time, Jonathan Camarda. We'll keep our hands on the wheel and stay frosty.